Good morning and welcome to the IP Group PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Greg Smith, CEO. Good morning, sir.
Thank you, sir, and hello everyone, and welcome to IP Group's 2022 half-year results presentation. Thank you very much to Mark and the whole team at Investor Meet Company for hosting us again. And of course, thank you to everyone who is online or watching a recording for your time to hear this update from us. And this is the third time that we've now used Investor Meet for our results presentation, and this is part of our continuing efforts to dial up our IR activities and get the IP Group story to as many shareholders and potential shareholders as possible. Now on the call today, I have myself, Greg Smith, I'm the Chief Executive of the company. We have David Baines with me, who is the Chief Financial and Operations Officer. We'll also be joined later by Sam Williams and Mark Riley, who are respectively the Managing Partners for our Life Sciences and our Tech business, particularly for the Q&A piece. And this morning, David and I are here in our UK head offices in King's Cross, and some of you who dialed in or even attended the investor update we gave before our AGM in June, you might remember the story that I told at the time of the fact that the 1996 Channel Tunnel move catalysed the development of this whole area. We hear now it's sort of, one of the hottest places in the world, and people are relocating from Silicon Valley even to be here, and it's known now as London's Knowledge Quarter. But interestingly, this was an initiative that was backed by the UK government, by industry, and by long-term capital. And I genuinely believe that the wider opportunity for IP Group is to do something similar in our space, and the trigger may well be the recognition of the need for science-based solutions triggered by economic or geopolitical dislocation, or it might be an increasing realization around climate. And certainly from my point of view, the early summer heat waves that have affected the UK and Europe in recent weeks have been yet another reminder of the importance of this. What's clear to me is that these events are continuing to shine a real light on our mission to build a better future, to deliver financial returns, impact, and to do so with an inclusive and diverse culture. And for our shareholders, for all of you, we're a long-term play on disruptive technologies. Now, the results presentation is up on the IR section of our website, but please note the usual disclaimers here about the nature of this update. So in terms of the running order for today, I plan to cover a short overview, an update on how we've delivered over the past 5 months since I spoke to you for our full year results presentation in March. And that will include an update on the 3 priority companies that I highlighted at the time, as well as the increasing depth of our thematic focus areas. Dave will then run through the results for the year, and then I'll wrap up with a short summary and then on to questions. And as the Investor Meet team said, please post questions into the Q&A section, and we'll endeavour to cover them all in the time we have available. So in terms of the overview, there's 3 key messages for this half year, and you'll have seen the release this morning, but firstly, I'm pleased to be able to report strong progress in those 3 priority companies that we highlighted in March. I'll come on to each of them in turn, but overall, these 3 companies have seen a positive net fair value change in the first half of 71 million. Now, our overall NAV per share at 137p is up very slightly from this time last year. And so overall financial results, we've broadly in half 1 seen a reversal primarily of Oxford Nanopore's increase in value that happened during half 2 of last year. The second point is that your company is very well financed and has strong liquidity, something that I and we continue to believe is a strategic asset in the current geopolitical and market environment. We've got strong gross and net cash position, and today we announced that we've arranged an additional long-term debt placement, and Dave will give more details of that shortly. And then thirdly, we have a continued commitment to shareholder returns. Now, of course, the primary driver of shareholder value will be capital growth, and that will be fueled by the delivery of returns on NAV through our portfolio. But we do seek to supplement this with cash returns. And our approach, which is realizations based, is to return a proportion of all realizations in the form of dividends and buybacks. And although we haven't delivered significant realizations in the first half, we'll be making an interim dividend of £0.005 per share. And in total, this will make 57 million of cash returns to shareholders since the start of 2021. Now, before I go into the meat of the presentation, I thought it was probably worth just a few comments on what we're seeing here in the markets in which we operate. And this won't be new news to the many of you who follow our space, but we are clearly operating in pretty challenging geopolitical and public market conditions. I guess a few points on this. Firstly, the public and private markets are linked, but they do operate differently due to factors such as funding cycles. The funding data that we've seen to Q2 in the venture market does actually show signs of resilience. That's in terms of investments, in terms of committed capital. But as we've seen in our own portfolio, there's definitely been a slowdown in realizations and exits. There's often a public to private lag, and the sort of pre-IPO and later growth companies are generally affected first in terms of valuation. And there's been no significant direct impact on the funding rounds for our companies in this half, and Dave will come on to talk about that. And I think that's because commercial progress is often the most relevant factor for fast growth science and technology company valuation. So that's very evident in our portfolio. And then from a team point of view, we have an experienced team who have invested across a number of cycles, and so we will manage our resources appropriately while ensuring that we maximize the opportunity for our leading companies, and we've got evidence of that in the first half. And then finally, this point around the fact that our progress and our capital discipline means we continue to have a strong financial position. But in terms of the opportunity, we still see that fundamental demand will continue for the products and services in life sciences, in clean tech, and deep tech that our portfolio companies are delivering. And I think that Martina, who spoke, who's the CEO of Featurespace, who spoke at our investor update, I think she really clearly exemplified this when she was talking about the demand for her products and services. And I think also history tends to show that those with capital and expertise will have significant opportunities to either create or access tomorrow's best companies during times of downturn. So in terms of an update on the strategy, so for this full year results back in March, I set out sort of three main areas of our evolving strategy. And I guess the key message I'm trying to get across is that 5 months later, we're delivering against those. I'll talk a little bit about impact and sustainability later, but in terms of the leading companies, good progress across all of them. We focused larger investments, including 10 million into Estesso, and as announced yesterday, Hysata, one of our sort of emerging companies. That focus on fewer companies also presents an opportunity for private capital partnering, and I'll talk about that briefly too. And then in terms of deeper thematic focus, the fundamental reason for us to have that is to have deep capability. And that means in our sectors, in the sectors that we operate in, we have talented and experienced partners and investment professionals who have worked through economic cycles, who are experts in their fields, and who are thought leaders in their ecosystems. And I believe that this will be important in allowing us to play and win in our chosen sectors. And I talked about our plans to accelerate our track record in sustainable future, which is one of our three thematic areas. And I talked about that the full year and at the investor update. And as planned, we launched our first evergreen venture investment platform focused on clean tech, owned and funded by IP Group. So we've made good progress against those strategic focus areas. So in terms of sector expertise, I don't want to spend a long time on this, but in terms of sort of trying to exemplify the sector capability that we've built, I just wanted to include a few pieces of evidence to support that. So in terms of recent highlights, this is over the last year or two, of course, people will be probably most aware of Ceres Power and of Nanopore, but also in 2021, we saw the exit, the sale of Innovata to NeoGenomics. This is a liquid biopsy business, and that was for almost $400 million, which netted about £64 million of cash to IP Group, and also Wave Optics in the tech enriched space, and that was sold to Snap for around $550 million. And that, we believe, is one of the largest VC-backed deep tech exits in Europe ever. So the track record is broadening out, and it's becoming wider. Then in terms of the people who we co-invest with, we really have a high quality list of co-investors globally, and they include both sector specialist investors, but also broader long-term investors from our ecosystem. And then finally, just to sort of underline this point about realization, since 2020, we've made nearly 400 million of realizations. Now, of course, that slowed in 2022 in the first half, but I think importantly from an overall portfolio delivery point of view, less than half of 2021's realizations came from Oxford Nanopore. I talked about this theme of deep sector expertise, and I mentioned our plans to accelerate our track record in the sustainable future space, and I highlighted the fact that we plan to launch this new initiative, and I was delighted to announce that we formed this new clean tech platform called Kiko Ventures. We believe this is the first evergreen venture investment platform that's focused on clean tech. It's wholly owned and funded by IP Group. Those who joined us for the investor event or watched it online afterwards will have heard one of the three highly experienced partners we have in that space, Rob, who talked about the opportunities that we see in this space and also a bit about the portfolio that we're building. Our plan there is to invest 200 million over 5 years, and that includes companies such as Bramble that we invested 10 million into during the first half, and Hysata that I'll come on to talk about shortly. So as part of the strategy, I talked about this sort of increased focus, fewer conviction companies, and the idea really here is that the business is trying to create meaningful category leading businesses that have at least billion-dollar company value potential, and partly in response to feedback from shareholders who are trying to get a better understanding of the value drivers in the future for the group's returns, we committed to setting out the opportunity and also the value creation milestones for these leading companies. And at the year end, I highlighted three. That was Istesso, Featurespace, and First Light. And I wanted to just provide a brief update on progress in each of those three. So we'll take each in turn. So firstly, Istesso, as a reminder, this is pretty emerging science. The whole field in which Istesso operates has only had a name for 7 to 8 years, and we have the most advanced clinical stage asset in this field, and the plan is for that to go into phase 2B shortly. The company itself has more than 30 consultants. We run it as a virtual model, but incredibly experienced team, more than 680 years of combined experience, and they've overseen the launch of 4 marketed products in their history. Now the big opportunity here is that about 5 to 10% of the world's population suffers from various immune conditions, and rheumatoid arthritis is one where the body's immune system attacks part of the body in its joints, and it creates a massive reduction in the quality of life, and it's a huge problem to be addressed. And what we have in Istesso, and we own about 56% of this company, into which we invested about 10 million during the period, is a first-in-class therapeutic. And this is really interesting, but the next milestone for it is this phase 2B trial. Anyone who's interested can see the details. There's a public disclosure of this on a site called clinicaltrials.org. And this is a trial that will be dosing 224 patients. They'll have sort of moderate rheumatoid arthritis. It'll be about 18 months in duration. So we expect this to read out in early 2024. We're looking for a classic endpoint in this space, but we're also looking for side effect profile. So I hope to be able to give you update on that by the time we get to the full year. So good progress there. Secondly, feature space. As I mentioned, those of you who dialed into our investor update will have heard Martina talking about both the opportunity and the progress for this business. This is one where and Dave will come on and talk about the valuations that we've done during the period, but Feature Space is a Cambridge spin out, and they are applying machine learning and neural networks to be able to combat fraud and financial crime. Huge opportunity. In terms of the investment story, it's relatively simple. This is all about recurring revenue growth, and Martina talked very confidently and clearly about their progress to date in delivering against their objective to outgrow a very fast-paced market. The market is growing at sort of 30 to 50% per annum, according to all of the analyst reports, and the market Feature Space is seeking to achieve ahead of that. So great progress at Feature Space. And then finally, for those three, First Light, of course, for those in England, those in the UK, we had a world first only last week when England's women won the European Championship. But our world first was at First Light, and they were the first company to achieve a fusion reaction using what's called projectile-driven inertial confinement. And there's a couple of different ways that you can approach fusion, but ours was successfully delivered, and this was validated by the UK's Atomic Energy Authority. Now, the interesting thing here from a IP Group shareholder point of view is that I think it really exemplifies the model well. So we understood the potential of this sort of the hydrodynamic simulation tools that the company had developed in the University of Oxford about 10 years ago, and we've backed the company all the way since then. And the interesting thing is the ability of that company to model the system has allowed them to identify a route to practical fusion using projectiles. And the idea is you use projectiles to compress down a fuel pellet and you generate fusion plasma. This is more efficient and it enables simpler hardware to be used, such as a gas gun. Now, demonstrating with fusion with this approach is an incredible achievement from a top-rated scientific team, and it's happened at a fraction of the cost of other fusion programs. Fusion is really difficult to achieve. It's very risky, but the goal is enormous. And compared to other fusion approaches, this is a much lower cost. So the company in total has raised about 80 million and spent about 40 to 45. And others require sort of super low temperatures or magnets or special materials. During the period, off the back of that result, we doubled our valuation. And as some may have seen in the press, the company plans to raise additional capital to go on the next stage of its journey and deliver and build this gain reactor machine over the course of the coming years. So that's really strong progress in each of those three companies. And what I thought I would do now is just give you an insight into a company. And we announced the Series A funding round for this company. It's an Australian business, Hysata. And of course, it's too early for us to be able to talk about timeframes to commercial scale and potential billion-dollar valuation, but it's a really interesting company. And so I really wanted to highlight this as a potential company of the future. I've set out here some of the milestones and the progress. So the mass manufacturable stack, we would be planning to have demonstrated that during 2023 and complete field trials during 2024. But I thought no better way to exemplify this than to hear from the company's CEO, Paul. And the video will be available as usual on our website. And so I'll ask the team at Investor Meet to run the video, please.
The unfolding climate crisis shows the pressing need for transformative technologies to help put us back on a path to net zero emissions. Hysata's mission is to accelerate the shift away from fossil fuels by delivering the world's most efficient, simple, and reliable electrolyzer. Green hydrogen is a must-have for reaching net zero emissions. It's the key energy carrier we need to decarbonize the hard-to-electrify sectors such as steel, chemicals, industrial heat, and heavy transport. Green hydrogen will grow to the size of today's natural gas industry, delivering 15% of the emissions reductions we need to get to net zero. This presents a challenge, but also a huge opportunity. Electrolyzers are the key technology needed for producing green hydrogen. These are devices that use electricity to split water into hydrogen and oxygen. When powered by renewables, the hydrogen produced is green, sustainable, and emissions-free. Existing electrolyzers are complex and expensive, and are at best around 75% efficient. Hysata is commercializing an entirely new category of electrolyzer, capillary-fed electrolysis. We have a simple and elegant, mass manufacturable design, delivering ultra-high system efficiency of 95%, or 41.5 kilowatt hours per kilogram. This is a giant leap in performance against incumbent technologies. Electricity makes up most of the cost of green hydrogen, so the efficiency boost translates to much cheaper green hydrogen. Additionally, our high efficiency enables us to drastically simplify the balance of plant, reducing the capital cost. With its ultra-high system efficiency and low capex, Hysata will deliver the world's lowest cost green hydrogen.
For a 1 million tonne per annum green hydrogen production facility, our electrolyzers will save producers around $3 billion in renewables capex. These transformational economics are really resonating with the gigascale customers we're talking to. There's nothing else in their supply chains that unlocks these kinds of savings.
Hysata's electrolyzer is built off game-changing technology developed at the University of Wollongong. This transformative advance in electrolysis was recognized in early 2022 in top-tier peer-reviewed scientific journal Nature Communications. Our technology's performance is truly groundbreaking, already meeting the International Renewable Energy Agency's 2050 electrolyzer efficiency target. Hysata has assembled a world-class engineering team to build a modular, mass manufacturable stack and a dramatically simplified balance of plant. Efficiency, design for manufacturability, and quality and reliability are core to everything we do at Hysata. Our people and culture are central to our success, and we've created a home for exceptional talent. We're incredibly proud of what we've achieved to date.
It's great to be part of a values-driven company with such a strong culture and mission to transform the global green hydrogen industry.
IP Group has had a profound impact on the success of the company to date, partnering with us from inception, bringing a blend of technical expertise, market knowledge, global relationships, and capital to the table. We really couldn't have done this without them. Based off outstanding engineering and commercial progress, we are now thrilled to announce we have closed a $42.5 million Series A investment round with incredible investment partners. Virescent Ventures led this round with participation from Kiko Ventures, IP Group Australia, Vestas Ventures, Host Plus, and BlueScope. We look forward to continuing to partner with our investors and customers to get this game-changing technology to market. With our disruptive economics, Hysata will transform the green hydrogen industry and become the world's leading electrolyzer manufacturer and an era-defining company. We're on a clear path to multi-gigawatt manufacturing capacity, which will make a major impact on reducing global emissions. We're excited by what the future holds.
Thanks very much to Paul, and hopefully we'll be able to report against delivery on that exciting future. It's clearly a huge opportunity, and one in which Kiko and the team have spent a significant part focusing on, and this was a really interesting opportunity that we identified alongside the Australia team. So hopefully gives you an idea of some of the interesting things that are coming through in the pipeline. So just a couple more slides from me before I hand on to Dave to talk about the financial results and the two other areas of strategic focus. So another area that I spoke about was this idea to make impact a more explicit part of the business and the portfolio. And of course, a lot has been written in market commentary recently about ESG and impact investing and impact investing trends. And some of this is definitely less than complementary. I mean, from our point of view, we think that strong ESG is really table stakes for a main market quoted company, and we continue to maintain that position. But the really interesting area, and this is something that we continue to embed in our investment processes, including through our ethical investment framework, which you can see on our website if you're interested, is this ability to measure, to drive, and to report against actual impact, genuine real world impact. And I hope that I will be able to exemplify this numerically towards as part of our full year results. But that's certainly a big drive for us. And further information in this whole area is set out in our most recent sustainability report. Again, that's available on our website. And then just finally, I talked about this idea of A, as having a strong financial position, and B, focusing more on priority portfolio companies. And of course, a lot of that is around capital and access to capital. And capital has always been a fundamental resource for our business, and we have always maintained access to diverse sources of capital, be that PLC equity, be that debt, be that a strong network of co-investors. And this is an area where I continue to see a really great opportunity now and in the future to grow our third-party private capital partnerships. And we've been looking at sourcing and growing and ultimately exiting companies, including our complementary funds. So we've been developing real expertise and track record in this space, and that includes sourcing an early growth fund. So that's funds such as Parkwalk, who are the leading manager in the UK of growth and EIS funds. But it also includes growth investors, later stage investors such as Host Plus. And Host Plus we've had a mandate for 2 or 3 years with Host Plus to invest internationally across our portfolio. And then there's also opportunities for growth and geographic expansion, and we're primarily doing that through our partnership with China Everbright, and we plan to launch that fund later this year. And of course, the fees that are generated by these assets under management contribute to reducing our net cost base, which is clearly important. But I often say to institutional partners that we speak to, we really are opportunity rich and capital poor. We invested about 70 million during 2020 out of about 1 billion across the whole portfolio, and about 100 million out of 2 billion during 2021. And during the first half, you'll see in our results, we were about 50 million out of about 350 million raised by the portfolio. So there remains a huge opportunity for us to do more in this space, and we continue to work on that opportunity. So with that, I will hand on to Dave, and he will give you an update on the financials for the period.
Yeah, thank you, Greg. As Greg said at the beginning, I'm David Baines. I'm the Chief Finance and Operating Officer of the group. I'm in fairly quick order, about 5 to 7 minutes. I'll quickly take you through the group's finances for the period. For those of you who have watched before, despite being a complicated business in terms of all the investments we make and all the exciting things we do, the finances are relatively straightforward. So hopefully, in this fairly short period, I can give you a pretty good idea of all the key points to note about our finances. The first point, but I think you've probably got the idea, we're financially strong. Gross cash of 236 million, net of 192 million as we stand today. Second point is our NAV. Now, those of you obviously were here at the year end will remember actually NAV got up to 1.7 billion. And we're back at 1.4 billion. And that's because of a loss in the period of 310 million, which I'll come to in a minute. Most of that really relates to just movements in the public share price of Nanopore, which actually has performed very well in the period, having had four uplifts in its estimates since its IPO. But it's obviously been subject to market conditions and has actually fallen in value by 60% in the period. We'll touch on in a minute how much of that loss relates to that. But what's really happened, one way of looking at it is we've pretty much gone back to exactly where we were this time last year. We had about 1.4 billion this time last year. We had net assets per share of £1.36. Today we're £1.37. So we went up in the second half, we came back down again. But as you'll see in a minute, most of that does actually relate to Nanopore, which itself is a very strong asset, and in which we have a great belief, and we believe much of that, if not all of that and more, will be recovered in the years to come. In fact, as you can see from this slide here, if we take out an Nanopore performance, we've actually made a profit in the period of about £36 million. So going to the next slide there, this repeats, you can see there, Nanopore down about 60%. I think at the end of the year it was £6.98, and at the period end it had fallen to £2.76. That's a 6% loss. But as I said also already, we hope that will reverse in time as the markets recover. Actually, ignoring that, as I say, or the actual performance of most of the rest of the portfolio has been good. I mean, you can see down the bottom, most of the negatives have actually been in the public market side. So you can see the total public market is about 395 million reduction in value, while the private portfolio has actually gone up by 100 million, which reflects how well some of our priority companies have performed. And if you can see over here in the diagram, you can see that one of those, of course, the First Light Fusion had its fantastic success getting Fusion. We've actually marked that up very conservatively at the moment. It was a doubling in value in the period to about 114 million on our books, but that's still well towards the bottom end of the range of the valuations we've been suggested, both by looking at comps, also by third-party valuations. And Feature Saves has also had an uplift because, as you've heard, its performance has been very strong. And just based on funding rounds, both Nexin and Hysata, as you've also heard, both gave us uplifts. So we've actually had very strong performance in the private portfolio. And it's really been those public companies, that's Centessa, Diurnal, and Nanopore, which have really accounted for nearly all of that 395 million reduction in the portfolio. Now, that might in turn lead to a question about our valuation process. I would understand there might be some cynicism how our public companies have fallen, our private ones don't seem to have done so much. What I would say on that is we've always been very prudent about valuing our companies. Again, those that joined us at the year end will remember that traditionally, in fact, for the last 2 years, we've exited companies. They've exited for considerably more than we've carried them in the books at the prior year end. I think last year, 191 million of exits have been carried at the beginning of the year, about 123 million. So, and that had been repeated the year before. So that sort of demonstrates by fact that we tend to be relatively conservative. When you look at actually our rounds this year, our private rounds, we found that over half were actually up, and that's 58%, very similar to last year. Similar number were flat, 33%, and actually only 8% were down rounds. Now, and we have some double evidence for that, because of course Park Walk, separate investment team, making investments mostly in different assets, some crossover, but mostly different assets. They made 12 investments in the period, and of that, 9 were uplifts, 2 were flat, 1 was down round. So we are seeing, remember those are based upon valuation of third-party funding rounds. So we are seeing relatively consistent valuations in our group, actually for the private portfolio. And the last point I'll just make up on that pie chart at the top is that actually quite a lot of our portfolio has also been very recently validated as well, either because they're public companies or because we've had external valuations. The top 5 companies, we all did external valuations, not top 5 private companies, to make sure we have updated valuations. And up to 10% of the portfolio actually did funding rounds in the period. So there's a number of reasons why we remain confident in those private portfolio valuations. Moving on very quickly again, you remember from the year end, very simple balance sheet made up basically of a portfolio of assets, of companies, so about 1.2 million of them, and some cash, as you heard, net about 190 million, very small amount of liabilities, so quite easy to see. And as I've already explained, a movement of 300 million over the period, due to that movement in the public portfolio, slightly mitigated by a private portfolio. Interesting, next slide, that £1.37 pence per share, those numbers there are how much each company contributes. Now, if you look at that, something like Nanopore, for example, is 20 pence of that value. You can see there, if you added up, nearly £1 of our value, 98p, is actually in of the top 20 companies, Nanopore and cash. So all the rest of it is kind of in the valuation for nothing when we're trading at sort of 80 odd p, and some more. So you've got nearly £1 of it just in those companies. So it is kind of quite hard to explain why we're at such a discount. But clearly there's a lot of substance behind justifying a higher valuation than that. Again, I'll go through this slide relatively quickly. It's just similar information. This just gives us an idea of how different areas fit over the portfolio, that total 1.2 billion of assets. At the year end, Nanopore was actually a very good proportion, but because it's gone down by 60%, it's gone from about 33% on its own portfolio to a more sort of manageable 18%. Life Sciences at 33%, Deep Tech at 18%, Clean Tech's grown quite a lot now obviously known as Kiko Ventures, has grown quite a lot to 16% because of the great successes it had in the period on Hysata and also on First Light Fusion. So it does actually look a more balanced portfolio at the moment. To some extent, we hope it'll be less balanced when hopefully Nanopore recovers and that'll take up a bigger proportion of the pie chart. Worth also noticing that of all the companies, people often focus on the number of companies we have, which is very much part of the model. Actually, 70% of all our value is in that top 20. So you see it's actually a very focused portfolio. One of the last two slides kind of just is really messaging about cash. I thought it made sense just to explain where our cash has gone on so people understand that. These are gross cash positions. We started 320 million of cash. Biggest area was investment, as everyone would want it to be. About 52 million has gone into our portfolio during the period, against about 350 million total raised by our companies. That probably in the second half will do a similar amount, maybe fractionally more than that in the second half, but it is worth noting that is down on what we anticipated doing at the beginning of the year. Clearly, as markets turned and our expected exits reduced, we have modified the amount we're planning to invest, as you would expect, quite frankly. The realizations are very low so far, only 2.1 million. We do expect more realizations in the second half. Some have occurred already, but they will be well down on prior years. And again, I don't think that's any surprise. We wouldn't really want to be selling much in the current market, and actually because of our financial strength, we don't have to. The third key thing to note really is around dividends. So this is the remainder of the share buyback. We finished about 7.2 million. That was finished in the first month and a bit of the year, and also dividends we've paid. So as we said, commitment to shareholders, we've made about 15 million being paid back to them. And the last thing worth mentioning, really, the last number is that 11.1 million on overheads. It's pretty much flat year on year. Actually, when you look at it, it looks slightly up. That's because the income is very slightly down. But actually, the overheads at the moment are about flat year on year. So they're really the main points I'd make about cash and our cash balance. Now, moving on to the last thing that we've announced today. This is to really increase our liquidity and put us in an even stronger position. So we've traditionally looked to have about 10% of our net assets in debt. Now, for a company of our type, that seems an eminently sensible amount to have. And of course, it hopefully means we give more efficient returns to shareholders, allows us to access more money to make into investments. We're delighted that we've managed to secure an extra 120 million pounds in a private place through a leading public insurance company and a small number of other investors. It's at 5.25 fixed interest rate. What we plan to do is pay down a little bit of the remaining 44 million we have of the European Investment Bank, pay about 15 million of that down now, and then so we've effectively increased our position by 105 million quid over the period. It's being drawn down in a couple of tranches. We don't need it today. We don't need to pay interest on it today. So we'll draw half of it, about 60 million, towards the end of this year, and half in about a year's time. And it's on 5, 6, and 7 year repayment periods. So it'll be paid back 27, 28, and 29. It compares very favourably to the EIB debt that we've traditionally had, which was on, as one can imagine, very good terms. These are on very similar terms, and we're very pleased we've been able to secure this facility at this time. And it allows us both to keep investing at a time when obviously a lot of opportunity for us, but it also takes pressure off the need to realise exits until we have to. So it gives us even more flexibility about we maximise our return on investments. And with that, I'll hand back to Greg.
Thank you very much, sir. So 2 slides quickly in summary. So the first was just a reminder on the investment case for you all as shareholders, myself as shareholder. This is crucial. Obviously, we can't have the impact that we want to have on the world if we don't deliver returns for shareholders. And so the shareholder value proposition has 3 main components. And I guess the 3 I'd pull out are firstly, this differentiated access to impactful deal flow in companies. I talked earlier about the sector capability that we've discussed. It's about wider capability and processes. That includes our legal team, our IP support, fundraising. And part of my legacy for IP Group as CEO is to build on and scale and leverage that professional capability. Secondly, as our model is primarily based on identifying early stage science with significant potential for value and impact, and that would obviously mean that it would take some time for our portfolio to mature. But having been doing this for the best part of 20 years, we now have 5 to 10 more maturing companies that we believe will be fast followers to Nanopore and Ceres over the next 2 to 5 years. And so we expect our overall returns to improve, and we have an ambition to deliver 20% returns per annum. Now, of course, overall market conditions will be a factor in achieving this, and will be judged against the wider VC market over that time, but we have that as an ambition. And then finally, and we discuss this regularly with our institutional shareholders, I'm fully aware of the discount to NAV. There's been some improvement recently. It remains frustrating for me as a fellow shareholder for you all, And of course, we know that some performance is linked to the wider markets. We and others in our sector have a high correlation to the tech and the biotech industries, but there are three main ways that we're dealing with this. And in the shorter term, that's around increased IR, and in the longer term, that's around developing and executing against our sustainable capital allocation policy, and also obviously delivering returns against our NAV. And we know that cash returns are a helpful component of the overall return. And so we've set out this sustainable long-term policy, and the idea is to take a realizations-based approach and return a proportion of all realizations that we make to shareholders by way of cash returns. And so there is a continued commitment to do that. And as Dave said, we haven't seen significant realizations in the first half, but we're maintaining the small dividend. And the idea is that the dividend is a small but regular cash return. And then as we make realizations in excess, then those will be used for other mechanisms which are probably more capital efficient, particularly at the moment, in the form of share buybacks. But the primary driver of long-term growth is this ability to source and to grow specific companies, and we give access to shareholders on a diversified basis to those companies. If anything, we anticipate and see more opportunity in the current environment, and we've been prioritizing investments in our businesses. So the overall summary, to come back to where we started, clearly the context is this sort of volatile and uncertain geopolitical environment and markets. And as a group, we make long-term investment decisions. And so this sort of short-term volatility is particularly uncomfortable for our business. But this is where our experience, our deep sector expertise, our hands-on approach to managing our portfolio companies, and our capital resources and capital discipline will be most valuable in aiming to identify and to build and to back the best opportunities that will contribute to a healthier, a more sustainable, or a tech-enriched future. I'm really pleased to be able to report strong progress in those three priority companies. It's really important that your company is well financed, that we have 192 of net cash at the moment, and we have put in place a facility that will give us flexibility over the next 2, 3, 4, 5 years. And then thirdly, this point around a continued commitment to shareholder returns and the fact that we've returned about 57 million to shareholders since the beginning of 2021. So with that, I will conclude today's presentation, and we will turn to the questions. So if you have, lots of people have asked, if you haven't, please do so, and we'll endeavour to take those in turn. Dave, maybe you could compare for us, please.
I will compare, and some I'll have to answer as well. Yes, a very good array of questions. We'll start away. I'll try and do all of them, try not to duck any. First one from Lacey M, thank you. Is your investment thesis still solely based on backing companies with IP from universities? Or given the rapidly widening opportunity set, is there now a wider remit? I think that's really one for you, Greg, I'd say, to start with.
Yeah, so the investment thesis is heavily focused around backing science and technology innovation, and much of what we do, the vast majority of what we do, has historically, and I think will continue to be, IP from universities. You've seen that in the examples of new companies that we've formed during the period, and indeed during last year. There is a widening opportunity set. This is particularly in the clean tech space, but you should think of this as primarily focusing on IP-rich businesses that have a particular technology advantage. Our advantage as a business is to be able to understand and price that technology risk, and then help to build and develop companies based around that understanding.
Thank you. Second one, perhaps I'll answer this one, shall I? Would you set a dividend policy of, say, 1%, say 3% of NAV, from David D? Well, I think as Greg's just kind of explained, we're really looking to, we're looking at both the share buyback and also the dividends as kind of one package related to, amongst other things, the exits we achieve. We expect to keep paying a dividend almost come what may. We expect to probably increase in a relatively small amount each year. It's a relatively small increase annually is what we're looking at the moment. Probably what we will, it'll be more overall dividends and share buybacks, and probably be a ratio of really the value of exits we get. And I think if you look back last year, so it was 100, nearly 200 million of exits. We did buybacks of something in the region of about 35 to 40 million in total. So that gives you a kind of guide for that kind of ratio that we've got in mind. Next one, perhaps. This is a lot of good questions here from Paul C. Again, perhaps I'll do the first one because it's a capital allocation one. But then there's some trickier ones here. One for Sam coming up. Capital allocation. Should we expect increasing weighting to deep tech and clean tech themes versus life sciences? Could timelines for key catalysts be shorter? Perhaps I'll start, and Greg, I'm sure, will have a view. I think from my side, we've got no sort of predetermined view on this. You don't just say that division will get that amount. It's about, as a group, where the best opportunities are for returns that we can achieve. So we're evaluating our capital allocations all the time, formal meetings quarterly, now meetings monthly as well, looking at capital allocations. So clearly, overall, we'll be looking at where we think money is best invested. So obviously, within the themes that Greg has outlined, perhaps I don't know if you want to add to that, Greg. Or...
No, I think that's absolutely right. You know, the intention is to look for and build and scale opportunities that generate returns and impact. And so we look for huge market opportunity and huge societal need, and then we overlay that with our skill sets, our deep technical expertise, and so it tends to lend itself to those three thematic areas. The deep tech area is really quite interesting in this space because you've got some quite obvious application areas, things like cybersecurity, like feature space, which is very clearly aligned to positive impact on the world and reducing financial crime. But there are other areas like quantum computing, for example, or neuromorphic computing, and that's about really lifting other technologies through those platforms that will develop. And one of the things I think the industry is going to have to try and get its head around is how do you try to articulate the impact that something like quantum computing has on the world. And so that's work that we're doing, and we know it's a sort of a tricky area, but that's definitely the intention.
The next one is specifically an Estesso question. I'm delighted you're online, Sam, I have to say. Also from Paul C. What's the logic for methotrexate refractory RA patients while still dosing alongside methotrexate?
Yeah, can you hear me?
Yeah, we got it. Yeah.
That's in reference to the MBS 2320 phase 2b study. Good question, Paul. That is the standard study, the minimum study that one does, and the very typical study in methotrexate refractory patients. You keep them on the methotrexate because it would be unethical to take them off. So they're inadequately responding to methotrexate, but they haven't totally failed therapy. So when you've got a new investigational drug, it would be unethical to take them off current standard of care and switch them onto your drug. There is an argument, of course, for doing a study, for example, in TNF or biologic DMARD failures. So Paul, you know what I'm talking about. Those are the slightly more advanced current drugs, and that is something we would explore and we are looking at in supplementary phase 2 studies. But at the minimum, we need to do the standard study that everyone does in phase 2. Hope that answers your question, but email me if not.
Excellent. Thanks, Sam. Appreciate that. Then there's a last one from Paul. A question specifically around the new debt facility. Loans, scope to invest in current portfolio. How well does life science score on ESG? Well, the answer is you're right, it doesn't entirely. Really, the definition of supporting this institution's sustainable development goals is more wide-reaching than just, for example, the clean tech portfolio. It does actually map quite well to quite a lot of our portfolio, and in some instances, it does also map to the life science division as well, though not always. But we're very, very comfortable, very happy to support their sustainable investment aims and have more than enough opportunities for us to invest sums of money involved. There's no way really restriction on this, I would say. Next one, fill in a good nasty question. So I'll give that to you, Greg. In respect to the share price's huge discount to NAV, could you consider some alignment of management incentives and ordinary shareholders' interests before awarding bonuses? The present system does seem to ignore share price performance.
Yeah, Phil, that's a great question, and I suppose hopefully those who will have seen at the AGM, we've been through a significant consultation exercise with all of our major shareholders about how should the senior leadership team at IP Group be remunerated, and we settled on, I guess, sort of slightly unconventional on the main market, where we reduced actually the level of cash bonus that could be paid to the executives. So I think mine is now the lowest or one of the lowest bonus opportunities on the FTSE, certainly the FTSE 250. But what the idea was to create even greater alignment between the executive directors and shareholders by making the significant component of our long-term rewards in the form of restricted stock. When we made those first awards, the Remco decided that given share price performance over the last year, we should not award at the maximum level, so we actually reduced it by 25%. But the idea is over time that I will build up 3.5 times my salary in IP Group shares, and so I will be wholly aligned with shareholders in delivering against share price performance, and that will be very evidently and clearly the top priority for me. And although the amounts are relatively small, I bought shares when I took over as chief exec, and I bought shares again following the AGM. And I continue to believe that IP Group shares are a compelling opportunity. So I was entirely comfortable with having that shift in remuneration towards long-term ownership and alignment of IP Group stock. I think that's the way that senior executives should be rewarded in a business, particularly a long-term one like this.
Thank you. Moving on to Bill H. I'll try and answer this one. Would there be any advantages in transforming IP Group into an investment trust? It might then be better placed to highlight its high-tech strengths compared with successful private equity trusts such as HD Capital. Well, the answer to that is we do look at these regularly. We look at them all the time. We're looking at group structure. At the moment, we have no plan to change. I mean, our current group structure, we do think it served us very well. We do think that the way we're currently structured with that, but a permanent capital base in particular has really been unique for us and allowed us to do the things we've done. And for example, Nanopore and Ceres Power, these companies we've held for a long time. But then I wouldn't say never. We don't say never, and we will definitely look at structure readily. I think that's part of our job, try and make sure we maximize shareholder returns wherever possible. So I'm not saying never, we will consider, but at the moment, whenever we've considered these sort of things, we've remained with the structure we've currently got. Next one, David D. I'm afraid this is me again. I'm sorry, I don't mean to hog. Why are you offering a scrip dividend, which entails issuing new shares at a discount to NAV and diluting the NAV per share of all other shareholders? You could settle dividends in shares, either bought in the market or from Treasury. A dividend reinvestment scheme which would not dilute the NAV per share of other shareholders. Well, the answer to this, it's a quirk. There's a quirk in the Companies Act whereby actually we can't pay the interim dividend using shares we already have. So we have to issue new shares. Now, the amount involved is not enormous. It's why we decided to carry on offering the scrip. We've offered it before. We didn't want to change it. The number of shares that people actually take up in the scrip aren't enormous. At the year end, at the final dividend, we will be able to use shares that we've already bought back, so it won't dilute this. These ones we can't, but one, it's a small number. Two, we wanted to keep paying a dividend and offering these terms as we had before. And three, because we're committed to further buybacks at the right time, we can surely compensate for that small impact at that time. That was our thinking.
And we will look at neutralising that scrip. That's something we can do. You might not be able to technically use the shares in Treasury, but equally we could use our capital to buy sufficient shares sort of concurrent with it to effectively neutralise that small amount of dilution. So it's a fair point.
It's a good technical point.
Yeah,
one was discussed around this table only last night. I'll hand this to you, Greg. I think it's time for you to have some. Its focus is growth. Why have a dividend policy? Is it not better return on capital focused funds on growing opportunities?
Yeah, no, you're quite right, Andy. It's again a great question, one we debate all the time. I hope I've answered that in the way that we think about our capital allocation. The primary use of our capital, be it realizations or capital that we've raised over history, is around investing into companies that will generate organic growth and hopefully be very attractive financial returns. The intention for the dividend was to have a small amount, a small but growing component of cash, but it was meant to be a small consistent part, and then also to have the ability to use some of our returns where we have in excess of that to buy back shares. This is something we seek to balance all the time. We speak to our major shareholders about it, and we continue to review it all the time. But you're right, and this is the essence of that sort of capital allocation approach.
Next one, I'm afraid, to me again, Robert M. Are the private company valuations fundamentally discounted cash flow based? Are you and your co-investors having to change your thinking on appropriate discount rates given the movement in long-term dated bond rates? Well, without being too dull, I can give you pretty precise answers on this in terms of how we value companies. About 23% of our portfolio at this period end were actually public, so they're marked to market. 23%, so gives to a total of about half the whole portfolio. Another 23% were recent fundings, less than 9 months, and then another 10% were actually less than 12, just over 12. I mean, so over 12, but still recent enough that we stayed with them. We have a certain amount, about 21%, based upon adjusted recent finances, and really discount cash flow revenue multiples only about 16%. Give you an idea. And on those, generally, yeah, of course, we're looking at those discount rates all the time, and also they're factored also into the valuations that third-party valuers are using when third-party valuers are looking at our portfolio and deciding what appropriate rate to use is. So we aren't ignoring them. That is true. How did the external values of the 5 companies compare with your own previous valuations of those 5? They were actually very close. We had I think a couple were small downs and one was up, I think, if I remember correctly. So they were pretty close. They weren't significant, but where there were adjustments to be made, we did make those adjustments to the portfolio and made small write-downs as would be appropriate. We do tend to try and take conservative approach to our valuations. And we have at year-end 3 valuation committees, at the half-year 2, and we do sit and go through every company. And if we think it's appropriate, we mark them down. And I can safely say for all the ones we've had valuations, we've never marked anything above the mid-range. So if you get a range, we're never at the top. We're never better than the mid-range for any of them. And where appropriate, we have marked them down. I think 2 out of those 5 we did so. Right. Somebody said, thanks, guys. That's brilliant. I assume they're leaving. Okay, again, I'll probably go to either you, Greg, I think. How much competition is there for access to university IP? Are there any of your university partners where you get first chance to exploit the university IP?
Cool, Bill, that's a good question and a really long answer. I'll try and do it relatively simply. So it varies by sector and by geography. There are some examples, like in Australia, where we get first chance to exploit the university IP. Sometimes, if the university has an existing like university managed seed fund, they come in alongside us, have the opportunity to. Whereas in the US, there are just letters of intent where we have no first rights. And then in the UK, which is probably where this market has developed the most in recent years, we've seen the early part of IP Group's history back in sort of the early 2000s was built around exclusive partnerships. And we found that wasn't the most efficient way, both from the university's point of view or from our point of view. And so they evolved into various different guises. Ways that we access IP in the UK now tend to come through examples such as Park Walk, who manage the alumni seed funds for each of Oxford, Cambridge and Imperial, but also through our networks and our relationships with the key thought leaders and researchers in those areas in which we seek to operate. So in some cases we get first refusal, in other cases we don't, and the idea is to have that sort of blended, differentiated access to IP. That was sort of a short summary.
Yeah, that's a good
answer.
There's 3 more questions to go, so we should be fairly close to the 1 hour mark. Perhaps I'll quickly deal with this. How did Hysata's valuation change after the latest funding round? Well, there was an uplift. There was a decent uplift, and you can see in the presentation that an £8.4 million uplift we've taken to the books. We've recognised at the period end. We haven't at the moment, and you'll see if you look at the announcement, actually given fixed percentages. Company was particularly sensitive to actually people work out exactly what the pre-money and post-monies were. So we haven't actually publicised those. I can say they had a decent valuation uplift. We are very confident if it achieves the sort of milestones that it hopes to achieve over the next 12 to 18 months, there could be considerably more sizable uplifts at that time. We will see.
It's fair to say that we had about half the business, isn't it?
Yeah, we did. Yeah, yeah, that's fair enough. About half of what we take in the debt and the equity one place. So it's a significant shareholding in accordance with our kind of model. Second to last question, I think for you, Greg, probably.
Yeah.
What can you tell us about your thoughts on how long you will maintain the Oxford Nanopore shareholding?
Yeah, well, obviously Nanopore is a significant part of the the company, huge part of our history, and I think it will be a big part of our future. I guess the things I'd say on Nanopore, I mean, this is an expression of our strategy from cradle to maturity. We were the first investor, and we have a really great relationship with Gordon and the team. We saw them at London Calling. I and actually the whole board were up. We saw them in Oxford just a few weeks ago. And so we were the largest holder pre-IPO, and as a board we discussed and approved an overall approach to realizing the value, and that led us to realize 20% of our holding at IPO. And so we were locked up until April on the rest. And our view in the short term certainly is, in the current market environment, world equity markets seem to have been dislocated. This isn't the optimal time to sell, and we don't fortunately have to sell at this point. As Dave said, we're delighted with the progress in the underlying business, numerous upgrades, technology improvements, and the company is very well financed. So they have about 600+ million of cash. They announced a refinancing of their offices lately. So and they're still talking about breaking even in 2026, I think it is. So we don't expect them to need additional equity. So all of those things are positives. All that being said, the purpose of IP Group isn't to be a long-term holder of significant positions in large cap public equity. And so over time, there's a plan for us to reduce that position as a percentage of NAV. Part of that will be from delivering in the other companies, and part of that will be reducing our position. And of course, we plan, consistent with the capital allocation policy, to reinvest the majority of that and return some cash to shareholders. So I can't give you an exact time, but don't expect IP Group to be a significant holder of public equity as part of our business model over the sort of medium to long term.
Excellent. Another question's joined. So I've actually got two left. I misled you. I've got two left. One for Mark, I think one for Sam. Mark has a disadvantage. You can't see these questions, so it's coming at you blind, Mark. Is Hysata going to disrupt my holding at ITM Power through undercutting green hydrogen generation costs? That's if you're there, Mark. So.
That is a yeah. Look, potentially it will disrupt the entire hydrogen energy market. It's a really breakthrough technology. It has totally different economics to its competitors, and it does have that potential. It's it's an early stage technology, but as you can see, a lot of people have invested in it on the basis of its credence as a promising technology. And we think if you start to see the development milestones as they occur in the next 2 years, then it really does threaten that market, and there's a great opportunity there.
Thank you, Mark. Thanks, Christopher D, for the question. Last one, Gomi B. This is for you, Sam, if you're still there. You haven't spoken much about Hinge Health. Is the competition changing here?
Yeah, so again, Hinge Health's been a phenomenal success. It's been a great one for us. It's our second biggest holding in life sciences, a third after ONT and Istesso. No, I don't think the company is obviously based on the success of Hinge, other people would like to get into that market, but they announced recently that they had added more customers this year than they have added in every other single year of their existence. So they are growing extremely rapidly. I can't give you revenue numbers because those are confidential, but I can tell you that the expectations this year are also very strong. So we see no slowdown in Hinge at all.
Thank you, Sam. That's great. And I think that is the last of our questions. I'm glad to say they've all gone. Probably hand you back to Greg.
Yeah, or to the
Greg, David, thank you very much for that. I think you've actually managed to address all those questions from investors, and of course the company will review all questions submitted today and will publish their responses on the Investor Meet Company platform. But just before redirecting investors, provide you with their feedback, which I know is particularly important to you both. Greg, could I just ask you for a few closing comments?
Of course. First closing comment, thank you everyone for dialing in and listening for an hour and a bit to the updated story at the half year. I hope the three key messages that people have taken away are that we're making strong progress in the companies that we highlighted at the beginning of the year, in March, so over the first 5 months, and we're confident in the progress of those companies over the course of the next 6 months and beyond. Secondly, the key message is that your company is very well financed, and we've acted to ensure that continues and that we have flexibility in the current geopolitical and market environment. And then thirdly, we continue to have this commitment to delivering shareholder returns. We've changed our remuneration structure. We've continued to work on our capital allocation policy. And this is something which is very important in the long-term sustainable future of the business. And so with that, I thank you all, and I look forward to updating you in due course. We plan a couple of capital markets events in October, specific thematic ones, and to look out for news of those on our website in due course. You can listen in and hear more about some of the themes and the portfolio companies. Otherwise, I will see you all again, hopefully in early 2023, and we'll report hopefully on further great progress. Thanks all, and speak soon.
Greg, David, thanks once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of IP Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.
Thanks, Alessandro.